Hello, and thank you for tuning in to another edition of the Monthly Market Roll, where we typically look back at the economy, markets, investments, and other macroeconomic data for last month, and then roll forward to this month with our insights with what lies ahead. We're going to switch it up a little bit today. We talk sometimes about what happened before or now. We're together today. We have investment committee, and we just thought it'd be a good time to talk about it. It was a Fed meeting day, somewhat of a historical day on September 18th, and we thought it was a good time to get together. And I'm Brad Rathe, a partner, senior director of portfolio management at Waverly Advisors.
I'm John Cox, chief investment officer of public markets.
I'm Clay McDaniel, chief investment officer of private markets.
Well, I see it as a historical day. Anytime you see that switch, they did 50. There was a lot of talk, 25 or 50. What did you see today? And you listened to the conference today, Clay?
Well, they cut rates. I mean, I think it was expected. There was a lot of debate coming into it. Would they go 25? Would they go 50? What would the press conference look like? They at least met expectations, getting the ball rolling on rate cuts. When you look at the fallout so far on a short term in the market, pretty uneventful. It's really what you want from a Fed meeting. Yep. You don't want markets swinging around every time the Fed opens their mouth. And so pretty well forecasted. Fallout's been pretty benign so far. I think the economy's positioned well. And this is intended to help keep the economy on track.
So that was the what happened today. John, give us a little of the why. Why did they come to this conclusion? What was the data that supported this?
Right. So the Federal Reserve's dual mandate is full employment and price stability. And we've had a lot of low unemployment and job growth. That trend has turned a little bit. And I think that started becoming a concern. Unemployment had gone from low threes to kind of low fours. Monthly job growth had gone from over 200,000 new jobs per month to kind of right around 100,000 jobs per month. So the Fed wants to stay ahead of that so that we don't still continue to see that slide in job growth. And also from a price stability standpoint, inflation, which peaked at 9% in 2022, is now down in a range of kind of 2.5% to 3%. So it's continuing to move towards that 2% bogey that they've set. So it was just the time was right to make that first rate cut.
The one thing that the Fed moved to, I don't remember if it was 4 or 5 years ago, much more transparency. They have these quarterly call or actually monthly calls or whenever they're on. Give me a little bit on that. Is that helping? And what do you see from a transparency? What's going to happen next and some of the things? Because, the stability that they wanted, they seem to have gotten. So it seems to be working.
I think it's been a positive trend. I mean, if you go back and look historically, like the Greenspan era, there was a thinking that it was the wise sage in the room in a black box. But so many people are making investment decisions every day, whether you're at the corporate side, investment side, and you want certainty, you want stability over the long term that you can invest that capital and you're going to get a payoff for it. And I think that transparency from the Fed is very helpful in that, in giving confidence, giving credibility that, all right, I know they're at the helm. I kind of have a sense of what they're going to do, how they're going to react in the future. Powell specifically has been very plain spoken. I think it's been a welcome breath of fresh air. You can criticize certain decisions he's made, but I think it's been very helpful when you make a mistake for those not to compound, when you're very transparent, you're very plain spoken about what you're doing and why you're doing it.
How about you see, this no landing, hard landing, soft landing? It seems like they've thread the needle here a little bit. Is that what you're seeing, or what are you seeing from that?
Everybody's constantly redefining these based upon sort of what the argument they want to make. I would define soft landing as can inflation get back to the 2% target without a recession? Essentially, is what they're shooting for. But if you wait, there's a little sense of the old Gretzky metaphor of skating to where the puck is going. If you wait until inflation's all the way back to 2% before you start easing policy, you're probably too late. You've got to be thinking ahead of the game. Where is the economy going? And let's go ahead and get to that point. So there's a lot of science to it. There's a little bit of art. There's a lot of experience. If it were an exact science, we wouldn't be talking as much about it. So far, it feels to me like they've done a pretty good job.
So Joe, how does this impact, normal people, our clients? How does it impact markets, portfolios? What do you see as an impact from, what happened today?
Yeah, many times when you have an inflection point where either rates have peaked or rates have bottomed and there's a turn in the cycle, you start to see a rotation among asset classes. So we've been in this period where large cap growth technology has done so well.
Yep.
The Magnificent Seven. Not to say that good performance couldn't continue, but this could be a turning point, a catalyst for other asset classes to start performing better. Small cap, mid cap, dividend oriented, value stocks, maybe international with potentially a weaker dollar. A lot of people have been focused on short-term treasuries because they've been yielding 5%. That, if we're sitting here, when we're sitting here a year from now, is not going to be the case, and it's going to start changing even today. So I think it opens up the opportunity set for other categories and other investment strategies that we invest in. So I think it's a positive for globally diversified portfolios.
Does it impact this $6 trillion, right, sitting in bank accounts, money markets? Do you see what impact on markets is that going to have if it does start to come out of there? Is there an impact from that?
Well, I think there are investors and just savers who have parked money in treasuries or CDs because they can get 5%, and that's kind of a magic number, that 5% number. But if that number is 3.5 or 3.5%, they're probably going to be looking for more return potential. And the bond market offers significantly more return potential than that. So, we could be looking at 5 to 7% in the bond market, even as short-term rates come down. And also people that were just waiting for kind of the dust to settle on what the Fed was going to do, and they were going to just stay in the ultra-safe securities until that happened. Now it sort of happened. The Fed has put this in motion, and so this $6 trillion might start to find a home in dividend-paying stocks or value-oriented stocks.
Well, this is a great conversation. Thanks, Clay. Thanks, John. And thanks for listening to the Monthly Market Roll. If you like what you heard, have any questions, about the topics we discussed today, feel free to reach out to Waverly Advisors. Information on how to reach us is in the description, and you can get more information at waverly-advisors.com. And thank you again for listening, and we'll see you on the next video.